Hey there, everyone. Welcome to Chart This with Dave Keller. Happy Thursday, July 23rd. Welcome to the show. My name is Dave Keller with Market Misbehavior. It's a gorgeous, warm summer day here in Redmond, Washington. The cooler temps are supposed to return for us tomorrow. But for now, we're left with some heat here in the Pacific Northwest. And unfortunately, a lot of red in the markets today. With some significant exceptions, which we will make a point of pointing out. This is very much a risk-off day, led by consumer discretionary, led by communication services, certainly not helped by technology. So some random names kind of working, including one semiconductor name looks like a pretty good bounce after the close, after their earnings. But overall, the damage was done today. So here's what we're going to do. We will try our best to separate sort of the signal from the noise, separate the short-term, fluctuation with the long-term signal. And I would argue that is the game in a lot of ways, right? The way you navigate periods of market uncertainty is focus on key levels, key signals that help you differentiate between getting really excited on big one-day up moves, really negative on one-day down moves, and just having a little more of a mindful approach and thinking about which moves really matter. And I would say 2 different days where the S&P is down 1.2% can mean very different things, because a 1.2% down day where the S&P is still range bound, it's not that bad. A 1.2% down day that pushes us below a key level of support, very, very different, right? So context matters, I would say, with the markets. We'll do our best to help give you some context today. We're live streaming on Facebook, YouTube, and X. I appreciate you guys so much tuning in live. Those that are doing so, please feel free to ask questions as we go. If you're watching the show later on our YouTube channel, thanks for checking it out. Please feel free to ask questions using the comments section there. Here's what happened today. Risk-off move big time. The S&P 500 closing around 7408. It did get below 7400, but managed to bounce in the last 10 minutes or so to hold that level. So down 1.2%. The NASDAQ composite, a lot worse, down over 2%. Where else is I going to look? NASDAQ composite, by the way, noticeably bottomed out right around 25K before sort of establishing the lows for the day. The S&P mid-cap 400 index was the best performer, but still down today. And volatility was pretty excessive here, right? The VIX did briefly go above 20 just before lunchtime Eastern time. It did kind of come off a bit and finish down below 19. This is a pretty big jump, 2 full points on the VIX between Wednesday's close and Thursday's close. So for us, level of 20 is an important one to watch. VIX stays below 20, even if it's moving a lot. Usually doesn't mean there's that much to be concerned about. VIX over 20, everything changes. So we noticed that. Of course, we've been focusing on that here the last couple of days as we've been teasing that 20 level, but not quite above there. For now, still okay, but certainly something we're closely observing. Looking at interest rates, 10-year yield continue to push higher. The 10-year yield is now above 4.7%. The long bond yield's teasing 5.2%. We were just at the local bank opening some accounts for my daughter who's heading to college in the fall. With the 10-year at 4.7%, pretty embarrassing, the interest rate you're getting in a savings account these days, but that is not where the yield is going to be. There are other places that yield better. 10-year around 4.7% doesn't look too bad compared to zero, but it is sort of trending in the wrong direction. So what's happening right now is the dollars continue to push higher. You can see the UUP was up today. 10-year Treasury yield up today. So we're seeing higher dollar, higher rates. Very much feels like a risk-off kind of rotation when you compare it to some of the other data points that we'll share with you here. All right, looking at the commodity space, by the way, I had a really fun conversation with Ms. Schneider just a few hours ago. That's now with my editor, and we'll hope to get that out to you as soon as we can. But we did talk about commodities. We did talk about agriculture. We talked about metals. We talked about sugar. It was a really fun conversation, among other things. Also, transports and retail and other things as well. But it was a very fun kind of commodity focused discussion. I'm excited for you guys to check that out later this week. But commodities are top of mind for me right now. Metals all down today, right? Gold and silver continuing lower. So gold actually bounced higher. I think it was on Tuesday and Wednesday of this week. Still holding 4,000 an ounce as a floor. bounced higher, I think, yesterday, but kind of coming back a bit here today. It was just about $4,100 an ounce on yesterday's close. So gold and silver down, copper prices lower. The big movements, besides some of the soft commodities that were up a bit, of course, crude oil, right? The headlines out of the Middle East becoming more and more concerning, I feel like, as this week is going on. Both the crude oil and Brent crude commodities were up over 6% today. Brent crude now finished the day above $100 a barrel. Crude oil, WTI crude oil, which is the U.S. benchmark, just over $92 a barrel. Again, both of those up 6.5% to 7% or so. Looking at cryptocurrencies, kind of in the risk-off move, moving in a very similar fashion to equities and to the metals. Bitcoin down 1.5%, holding just above 65K as we go live here on Thursday, July 23rd. Ether prices down 2.5%. You can see most of the top 10 coins slightly in the red today. Looking at the 11 S&P sectors, for what an absolute drudging this felt like, I'm sure to many of us, worth noting that 4 out of the 11 S&P sectors finished in the green. On the downside, let's start with the bad news. So we had Alphabet, that's your name, and Tesla both reported earnings. Both of them gapped down big time. We talked on yesterday's episode, checking the after-hours trading, noting that short-term weakness after their earnings release. Today was pretty rough for both of those names, and the weakness in Tesla. The problem is that's a big down day and a huge weight in the XLY. Other stocks in the XLY also struggle, but that big down move for Tesla was part of the story, which drove XLY down 4.6%. That's a pretty painful session for that ETF. Communication services, which of course is Alphabet's sector, that's the biggest name in the sector, down 3.5%. Consumer staples, honestly, one of the more defensive sectors, third from the bottom, down 1.4%. Technology was sort of in the middle of the pack, but still down 1%. Of course, that's a big weight in the S&P and certainly in the NASDAQ. So the weakness there is probably the biggest pain point for equity. So what we're going to do today, in some cases, is sort of track this one day sort of disaster of sorts and look at what today's drop in some of these growth sectors did to the major indexes. But let's also make sure we spend a decent amount of time focusing on what worked. Industrials were up today, up 1.7%. You had CSX report after the close yesterday, went really well. You had Union Pacific reporting today. Railroad stocks are looking pretty good. Those charts look fantastic. So the industrial sector up 1.7%. A lot of aerospace and defense names like Raytheon and others moving higher, partly in some cases because of earnings, but in a lot of ways because of the conflict re-escalation in the Middle East, causing all the defense names to sort of push higher. Healthcare, number 2, up 1.3%. So let's note that's a sector doing well when the indexes did not. Utilities and then energy, both in the green, despite the broader market weakness here. Breadth was not good today. And to be honest with you, breadth was pretty bad. On the NYSE, which is that top line, 28% up to 70% down. Middle is the S&P 500, 43% advancers to 57% decliners. Small caps at the bottom, and that's been an area certainly of strength here in recent months, also struggling. So breadth across the board was not particularly good. This wasn't one of those where tech was down and everything else was up. This was sort of like tech was down and a lot of other things were down quite a bit as well in terms of the sectors, in terms of the breadth. This was a pretty good down day here. We'll see what happens because I don't formally update my market trend model until Friday after the close, but it looks highly likely, barring some big recovery tomorrow, which is absolutely possible. But unless we get a big recovery tomorrow, it looks like my short-term model will remain bearish on the S&P 500. We haven't had 2 straight weeks of bearish short-term readings, probably since the March 2026 period would be my guess, going down into that low at the end of the month. All right, looking at the 9 Morningstar style boxes. Hey, mid-cap growth was actually up today slightly, which I found surprising when I reflected on all the names that were down, but it shows you the mega cap growth names that were really struggling today, right? Alphabet and Tesla and similar kind of names. So large cap growth down the most, 1.7%. Mid cap growth, basically flat for the day, and that was the best performer. Generally, growth underperforming value today, but it depends on what part of the market we're talking about. Hey, let's also pay special attention to stocks that were up despite the fact that broader themes were down. Micron was actually up 3.2%, and Intel was the name I alluded to earlier, up pretty good in the after-hour session. Looks like pretty good earnings from Intel. So some of the semiconductor names just kind of navigating just fine through all of this. Not all of them, because plenty of them are struggling, but MU up 3.2%. SpaceX, which I would say without a doubt, still not a good chart, but it was up 2.6% today. So that's one of the rare up days we've observed since its IPO. But of course, the real problem is down at the bottom of the list, where you have Tesla down almost 15%, Alphabet down over 7%, and then Amazon down 4.5%, Meta down 3.33%. So big risk-off moves at some of the biggest names. And so again, I think the heat map is going to be especially helpful today when we think about areas of the market showing strength. By the way, I don't refer a lot to this chart list of the Dow industry groups. These are Dow indexes that I've tracked for a number of years, but it's worth noting that four out of the 5 top groups today were all in the industrial sector: defense, aerospace, industrial suppliers, and then railroads at the top of the list. Biotech also made it into the top 5 there as well. All right, let's continue on looking at the heat map. We are going live here on Facebook, YouTube, and X. Looks like we're getting some good comments and questions on all of those platforms. Thanks to those of you tuning in live. Please ask questions as we go, and I'll do my best to take some along the way. If you're watching the show later on our YouTube channel, just use the comments section, and we'll answer your question. By the way, Gary, thanks for this. Greetings to everyone. Looking for Dave to aviate, navigate, and communicate these turbulent markets for us. Do you know why he used that phrase? And thank you for that. Aviate, navigate, communicate. That is a phrase you were taught as a student pilot, because when things start to get messy and you are in some sort of emergency situation, you are taught to aviate, navigate, and communicate in that order. And what that means is, first off, fly the airplane. Don't get so caught up trying to use the radio that you lose track of what the plane is doing, right? Regardless of who's trying to talk to you, number one, fly the airplane. Number two, figure out where you are, because before you can talk to other people and have anything really meaningful to say, you have to sort of establish where we're at. Am I in a safe place? What visual cues can I do? Can I figure where I'm at on the map? Can I look at my instruments, figure it out? And then only after you've gotten the plane to fly and you figured out where you are, then you start worrying about communication, because our temptation when you get into emergencies to get the radio and start talking like Mayday, Mayday, uh-oh, what do I do? The problem is, if you do that and you're not flying the airplane, that's not going to end well. And so that order of operations is remarkably important. There's a great parallel there to investing. So I love that. Thanks for that. Thanks for sharing that. It was a good throwback quote there. All right. So, hey, listen, for what a big, scary down day this was. And to be clear, this is a pretty big down day for a number of stocks. Obviously, 2 of the Mag 7 names getting crushed post earnings, not feeling particularly great. The 2 largest names in consumer discretionary were down big. The 2 biggest names in communication services were down big. Those are 2 significant drops. But if you kind of cover up the middle of your screen and look elsewhere, technology, not great, but not horrible, right? And there were, the things that were down today in tech are all the software names, right? AppLovin, CrowdStrike, Salesforce. These have not been generally great charts anyways. So ServiceNow is still not a great chart. But there were plenty of things that were kind of not down, right? And it's Micron, it's SanDisk, it's Seagate. These were not great up days, but they didn't go down. So a lot of the semiconductor names actually held in there just fine. So kind of mixed in technology, obviously more negative than positive, but that's worth noting. Number 2, looking in the industrial sector, look in the healthcare sector. If you didn't know that the market, benchmarks got crushed today, I mean, those aren't bad days, right? I mean, it looks like pretty good movements in industrials, especially, some of the groups that we mentioned, railroads, aerospace, defense names, of course, all sort of moving higher. Some of that's earnings this week. Some of that is just a reaction to what's going on in the Middle East and sort of the latest headlines there. But industrials continues to be a pretty interesting place with a lot of really good charts in there, by the way, right? I mean, CSX is just kind of up and to the right, long and strong, as we would like to say. The healthcare sector also doing pretty well. Now, a lot of these charts have been struggling, but like TMO is one of those that it's kind of been sneaky improving. And then just today, with earnings, I think this is before the open that they reported, big gap higher today. So, stocks like this, I usually on a chart like this would be kind of patiently waiting for a valid break above the 200-day moving average, valid break above these levels. That all happened with a huge gap up today. The question now is, do we sustain that breakout, right? Do we see additional accumulation now that the stock's been bid up from, 520 up to 570 from one day to the next? And so that's going to be the question for any of those names that kind of gapped higher. But in industrials and in healthcare, plenty of stocks that did pretty well today. I don't think it's time to be too worried about this, but I am definitely, given what's happening in some of these big growth sectors, I immediately, look to the defensive sectors and see, are we getting movements into utilities, into REITs, into consumer staples? Definitely not consumer staples, broadly speaking. Continues to be a pretty tough place from a technical perspective. Utilities were actually toward the top of the leaderboard today, and the relative performance in utilities is starting to wake up a little bit. One of the biggest sort of red flag situations I look for in this kind of environment is defensive sector starting to improve. You can see that if you just look at the relative strength of a defensive sector like REITs versus the S&P. You can certainly see it on the relative rotation graph, the RRG, which I use every week for my my weekly flight plan, which is my report to premium members over the weekend. We always look at the weekly and the daily RRG. And so I'd say, especially in the daily RRG, look for the defensive sectors to improve. You're seeing a little bit of that, but not enough that it feels like, wow, everyone's getting defensive. But that's the kind of thing I might want to be looking for right about now. So to summarize what happened in today's session, obviously a lot of pain in consumer discretionary and communication services. That was really the epicenter of today's drawdown. In technology, it's semiconductors still over software. That continues to be a theme, and a lot of the software names down more than semiconductors today. And some of the semiconductors were actually just fine. I think Intel's report today after the close, and certainly the reaction tomorrow, is going to be pretty vital. And then I would say elsewhere, industrials, energy, healthcare, these are sectors where we continue to see some pretty good charts and pretty good technical configurations, to be honest with you. All right, we're going to finish off with some charts. Before we do so, we're going to give a shout out to one of our partners, Koyfin. Go to marketmisbehavior.com/Koyfin, Koyfin. They've created a fantastic set of tools for financial advisors and for individual investors. It's a relatively low-cost product. I would argue way underpriced relative to the value that you get with all the great market data. It's institutional quality at an individual investor price point. I use it every day to look at ETFs and do some due diligence looking at ETF holdings. I also use it all the time for portfolio analysis, which is something I did all the time in an institutional setting, and applying that mentality to my own portfolios, to watch lists that I'm thinking about, really helps you understand a lot more about where returns are coming from and hopefully where the opportunities are going to be. If you're an advisor, fantastic tools to help enrich your conversations and your relationships with your clients through great reports, through fantastic visualizations that I think bring the markets to life during those conversations. You can find more info at marketmisbehavior.com/Koyfin, Koyfin. I want to thank my friends at Koyfin, as always, for being great partners to Market Misbehavior. All right, shall we look at some charts together? And we will call it a Thursday evening here. Today, we're going to look at, again, separate the short-term noise from the long-term implications of today's move. And I will tell you the quick version is breadth indicators getting a little less great to okay to not so great. In terms of price deterioration, S&P still kind of holding into that range that we agreed, or at least that I proposed, was a sideways phase. Until the S&P sort of gets below 7,300, I'm inclined to see this as a consolidation period. And I would say today fits in there. Sentiment was interesting with a big shift in the AAII survey, by the way, which we'll get to. But here, looking at the daily chart of the S&P 500, pretty good illustration, I would say, of this sideways phase that we've really been in since back here in May. Right, here's May, June, July, and you can see we've settled into this fairly consistent range around 7,300 on the low end, around 7,600 on the upper end. Again, I'm inclined to consider this market as being neutral, being sideways until or unless we break above 7,600, which I think would be quite bullish, or we break below 7,300, which I think would be quite bearish. Now, if and when those breaks happen, probably one of those things is going to happen here. The two things that I would look at to sort of validate that: number one, momentum. So if we break out, are we breaking out on enough positive momentum? If we're breaking down, are we breaking down on enough negative momentum, right? Can I validate sort of the significance of that move based on the momentum relationship to the price? Second question would be volume. Are we breaking down or breaking out on heavier than average volume? And that's something we really haven't seen a ton of volume here in this consolidation phase, which is pretty normal. But a lot of times what the great literature on price volume relationships would tell you, during a consolidation pattern, during a sideways pattern, market's in an equilibrium. So you don't really need a lot of volume for that to sort of happen. The move on heavier than average volume then sort of is an exclamation point to the next sort of directional move for the major indexes. For now, I'm inclined to see today's drop as still fitting within that sort of general range. That pink shaded area around 7,300 to 7,350, getting pretty close here after today's drop. The McClellan oscillator has actually been below zero for about a week now, and that's an indicator that's derived from the daily advanced decline data. The way to think about it is it's basically looking at the slope of the AD line. So it's a great kind of early warning system, because as the market's still kind of doing okay, and as the advanced decline lines are still kind of okay, if they go from great to just okay, the slope starts to change and the McClellan oscillator will go negative. So it's often a really good signal of a shift in breadth before some of the longer term breadth indicators would really register that change. That's why I like thinking of it, including it in part of my sort of overall picture of breadth conditions. McClellan oscillator has been below zero, which implies the slope is slowing down, which it definitely is. And so I would say getting back above zero would be a nice sort of green light pattern to this market. And we've not seen that. I mentioned the slope of the AD line. Here is the advanced decline line for the New York Stock Exchange. Pulling back for the last week, still okay, still above the 50-day moving average, but kind of coming off in the last week. You can see the large cap, mid cap, and small cap AD lines kind of all pulling back from making a new all-time high last week. So no new all-time highs yet this week, but still okay, right? And that's what I would say the breadth conditions right now is measured by the AD lines. That's how I would describe it, right? In the short term, kind of pulling back a little bit. The long-term structure still quite constructive. Tell you where there's been a significant shift is in the new highs. We've highlighted this chart before because I would always say that a healthy bull market should be marked by an expansion in new highs, right? Even if the S&P itself, even if the NASDAQ is not making its own new all-time high, you want individual stocks, those early leaders that are actually already achieving that. And only then do the major indexes have any hope of actually breaking out to their own new 52-week high, because individual stocks, those early names, are already kind of doing it. So what's happened is this week, here's Monday, Tuesday, Wednesday, Thursday, we've had way less new highs, right? This was going into Friday of last week. On Friday's session, about 11 to 12% of the S&P 500 index made new highs. Today it was around 3.5% of the S&P making new 52-week highs. The new 52-week lows almost outnumbered the new 52-week highs today for the S&P 500. So what's happened is we're not getting a lot of stocks actually making new highs this week. We're starting to get a couple more names every day making a new 52-week low. If you see a lot less green and a lot more red on this chart, that would be a pretty negative sort of sign. And that can happen before the major indexes break down. You'll start to see some new lows appear as those, sort of those really lagging names start to make a new 52-week low. But the lack of new 52-week highs here, I would say, is certainly a concerning development that we've noted this week. All right, the VIX is still okay. Earlier in the day, it did briefly push above 20. I would say on a closing basis, as long as we're holding 20, I think we're okay, which I think we are. We finished in an 18 handles, around 18.6, 18.7, which is kind of, sort of toward the upper end of that acceptable bull market range. Usually in a bull market, you'll see the VIX kind of between 16 and 20 a lot of times. That's sort of what we've seen going back to mid-April. Last time we popped above 20 was in June, early June, which is sort of telling us, yes, this pullback was something to not ignore and something to be ready for. So looking for another close above the VIX of 20. For now, we're still okay, but I think that's a chart we want to keep a close eye on every session now for that red flag to emerge. Kind of a shift here in sentiment. Thursday is when we like to check in on sentiment indicators like the AAII survey. This is a weekly survey of individual investors. If any of you watching are individual investors, you can go to AAII.org. Pretty sure you can sign up for it and participate in the poll if you'd like. Is it the most perfect, design poll I've ever seen? No. But is there great value in analyzing indicators like this and survey data that's been running for decades? I would argue absolutely. And it's really helpful to just see when there are big shifts. And there was quite a swing. Last week, we were around 43% bullish. Today, we're below 30%. Last week, we were around, 32% bears. Now we're up to 42% bears. There was a huge swing from bulls outnumbering bears by about 20% to the opposite, or 12%, to bears outnumbering bulls by around 12%. That's not the most negative, beaten down sentiment reading we're going to say, but we're ever going to see. But it does represent a significant quick shift from fairly constructive to fairly negative very quickly. So individual investors starting to get pretty skeptical. We did see a drop back lower in the name exposure index. That's the National Association of Active Investment Managers. So money managers, that was just around 96% last week, down to 84%. So money managers in that survey kind of tapping the brakes after getting a little more aggressive in last week's survey. I think rates are just one of the key developments to be monitoring here. The 10-year yield finished above 4.7%. The last time the 10-year yield was at 4.7%, I'll tell you how long it's been. I have to open up a new window because it's been over a year and a half. So I got to back it up a little bit more. Last time we were up at around this range was in January of 2025. That's 18 months ago, right? That's the last time we had the 10-year yield up to this point. May of this year was the highest reading we had seen. That was just below 4.7%. So interest rates are definitely going up. Now we're getting up toward the upper range, right? We haven't been above 5%. Got to go back even further, right? For the last time we were above 5%. Really far, actually, as I'm thinking about it. Yeah, we got to go. Yeah, there we go. This is the last time we were above 5% back here in 2006 and 2007. So make no mistake, the 10-year Treasury yield has gone up in a significant way. It's just been so sideways for so long. I feel like the market's kind of gotten really comfortable with this, 4 to 5% range. I'm looking at the last 10 years here, right? So this is sort of where the 10-year yield has been going back for 3 years. Said that, that drop in rates. Here's the COVID low. We had that big rotation higher as bonds sold off after COVID. Rates go way up. The 10-year yield got up to 5%. Then we've kind of just been settling into this sideways range. What's happening is we're heading more toward the upper end of the range. What's interesting is back here, the yield curve was inverted, right? The 3-month point, the 2-year points were well below or well above the 10-year points. So short-term rates were much higher than long-term. Now we've got the opposite, more of a normal shape where the short end is much lower than the long end. So interest rate environment, very, very different for sure. But I think that rise in rates is going to start having more and more ripple effects that we're probably just not used to having to deal with. Crude oil prices continue to push higher. And again, we've been betting on crude oil prices going up since back here, where we felt like the market was not pricing enough of a chance that there'd be a re-escalation of hostilities. So I'm not surprised by the headlines that we've seen. I'm not surprised with how quickly it's feels like things that had been settled have all become unwound. And I'm continuing to bet on energy stocks and crude oil prices generally moving higher here. What's interesting is with today's move up to $92 a barrel for WTI Cushing, which again is the main U.S. crude oil benchmark. That's the crude oil futures we talk about. The U.S. are basically tracking that kind of index. If you take the April peak and the July low, we're right at a 50% retracement. We've retraced half of that drop. The next big objective would be up around $98 a barrel. That's right around $100 a barrel. I wouldn't be surprised if that's an important level of resistance to think about. Offense over defense, very much favoring defense in the month of July. That seems to be accelerating here over the last week. Now, the cap-weighted version, the XLY versus the XLP, is really getting affected by Tesla and then Amazon, both down quite a bit today. So the numerator's losing a lot. But here's the equal-weighted version, which kind of takes the Tesla and Amazon overweight off the table, and it's still been kind of going risk off for the last month. So I would say this indicator kind of getting less and less supportive of any kind of recovery here really suggests that we're in more of a bearish situation than the performance of the major indexes may imply here. All right, to finish off here, let's look at Alphabet gapping lower on earnings. We talked during the the show yesterday, looking at the after hours session. It looks like it was getting dinged in the post market. Sure enough, we opened below the 200-day moving average and remained below there. We haven't been below the 200-day moving average. I think you got to go back to the 05 low would be my guess, earlier in that year. But it's been a while since we've been below the 200-day moving average. After this sort of gap, I always want to think about what happens tomorrow, right? I mean, there's a scenario where you get buyers coming in, pushing the price back up. You get like this bullish engulfing pattern right at the 200-day moving average. I've seen that happen plenty of times. For me, though, of course, going below the 200-day is not a good sign. Remaining below the 200-day moving average is pretty bad. I don't see anything on this chart that tells me obviously we want to be buying Alphabet, after that gap lower. Like, I just don't see that as the most reasonable way to interpret that. So for me, it's more, all right, we've had the gap lower, the stock disappointed. What do we see some signs of accumulation? Another thing I would point out is gapping below the 200-day moving average here. Let me zoom in a little bit. So I did a Fibonacci framework from the March low to the May high. And if you look 38.2% of the way, that matches pretty well that June low. 61.8% of the way was pretty much today's high. So getting back above like 325 would get back above that Fibonacci level and back above the 200 days. So like for me, that's the trigger I would look for as more of a trade. Like, do I want to trade a rebound and a retest of those levels? Yeah, let me get above that level first to show that there's something happening. But otherwise, it doesn't seem like a great chart to be thinking of just yet. Tesla, of course, got absolutely crushed. We talked about support at 370 going into the close yesterday. His question was that going to hold? It definitely did not. Now we've gapped well lower. We're now making a new low for the year. Tesla is a bearish chart until proven otherwise. It's oversold today, as is Alphabet, but again, no real sign of accumulation. Railroads are looking just fine, and I talked with Ms. Schneider earlier this afternoon about transportation stocks, which have generally been pretty constructive. Some mixed results in airlines, but railroads definitely pretty good. A lot of earnings in this group today and this week. UNP is on the earnings list. CSX was in there and yesterday and had a nice gap higher, arguably continuing that strong uptrend phase we've been observing for quite some time. Raytheon actually reported earnings before the open today, and I would say strong earnings also connected to re-escalation in the Middle East, causing the aerospace defense names to do pretty well. RTX is up about 7% today, actively testing that March all-time high. I think that's a good chart at this point. Innocent until proven guilty. All right, Intel's reporting after the close today. When I checked earlier, it was up almost 10%. Now it's up about 5% in the after hours. So again, the after hours session, I always tell people, like, don't draw too many deep conclusions from after hours trading. It's more of a short-term instant reaction kind of read. But for that, I think it's pretty valuable. It's currently up trading around 105, which would mean we're really just around today's high. This is not much of a move here for Intel. So I would say, when I'm looking at today and watching Micron pop higher, I'm thinking, boy, if you could get good earnings from Intel, I mean, obviously different company, different part of the semiconductor space, but at least would be some good news in the technology sector. It seems like the initial reaction is pretty good. Will that be enough to sort of continue this rotation from pullback to more accumulation, get above the 50-day? I think still to be determined. All right, let's look at a question or two before we finish. Richard, thanks as always for watching, my friend. You said, what is really scary is that the organizations in the AI area are getting harmed due to greater expectations of real revenue and not just orders that may or may not occur. I mean, so yeah, right? What you have to remember is we're in this situation where the amount of money that's being spent on AI infrastructure is staggering. I mean, we're talking GDP of a small nation types of values of these mega cap, hyperscalers, as they're called, and how much money is just being invested in infrastructure. That is creating a lot of great opportunities, right? So if a lot of these companies are building a ton of data centers and a bunch of infrastructure, all the names that build the machines that go into those things, all the stuff that is used to create that, and the energy that's required, that's going to cause those prices most likely to go up because they're getting a lot of orders. So for now, it seems pretty encouraging. The problem is they're spending a ton of money now. And it's all about the estimates of what they're going to be able to do to monetize that. And again, even if eventually these AI related companies do end up making a ton of money, which I would not be surprised if that's absolutely true, which companies will be making the ton of money, I would say is not 100% clear today. Which companies will those significant investments really pay out by having the best models and the best infrastructure and the best business model and all those things that actually you need to to grow your earnings and outperform your competitors, because everyone's trying to get into that business. That I don't think is particularly clear right now. This market is trading where it is and holding up as it is because of these crazy positive expectations. And again, if you're going to tell me that this time is different and that it's not unrealistic, I mean, just read anything from like the late 90s about the dot-com era and how dot-coms are different, and we can value companies differently, and it's obviously a transformative technology. Like, that is absolutely true. The internet worked, right? And it changed the way we do everything, but that did not mean that a particular set of internet names were a good stock to own at that particular moment. And I think right now there's this kind of euphoria around the expectations and the promise of AI that we're becoming disconnected from the theme, and then whether it makes sense to own those individual stocks today. I think that's one big gap. The other thing is you have to remember that even if these technologies prove to be the most important thing that's ever been designed by man, it's not a straight line, right? There will be these big swings. And I would say technical analysis, one of the great values is you don't have to sit there and ride through all of that noise just to get to this higher level. We can recognize when things are coming in and out of favor, and we can do much better than just buying AI and closing our eyes and our ears and our nose and hoping it works. I would argue that's what technical analysis is really good for. But your point is absolutely well taken there. Chuck, interesting question. How do you deal with stock prices as they start getting I'm guessing $1,000 or more per share, and it causes issues? I'm not sure what issues it would really cause. And I would tell you why. That used to be an issue when if you're managing a smaller account, right? If you're managing like an individual account, and it would be tough to buy a stock that was trading at $900 a share because you couldn't buy that many, or maybe you just can't buy a full share of a stock or something. Most brokers now offer partial ownership. So if you want to buy $20 of most names, a lot of brokers now allow you to do that. So I think that, so that the back in the day, it was, you would split shares just so the price would come down so that investors could actually buy, smaller investors could participate. That's less of an issue now with most places allowing you to participate. Volatility, I don't know, right? The volatility is going to be significant in terms of the dollar amounts. The volatility is probably not going to be as significant on a percentage basis. I would say my guessing is what you're probably picking up on is the fact that a lot of those stocks that are now trading up to $1,000+ a share are all these technology names that have gone euphoric and have gone vertical. So it's less the fact of what happens when stocks get above 1,000. It's just what happens to these kind of names when the volatility gets bigger. And I would say the vol that you're seeing in the technology sector, we've commented that when we just look at the heat map and say, look at these big swings that are happening today. Again, relatively quiet day with semiconductor names only, up 1%, and in software names only down 2 to 3%, because there have been days where there's much bigger percentage swings. So I would say if you're going to be playing those particular types of names, you're going to be experiencing greater swings. So what do you do about that? And at Argo 7963, 100% right. I think there's often, and I think, again, when you get to large dollar listings for the stock, right, a higher share price, it gives the impression that there's more volatility. That's not necessarily true, but I would say a lot of those names that have gone up to that point are pretty volatile right about now. Adjusting your position size based on volatility, I think, is a great way to think about it, right? One of the most fantastic lunches I ever had, and it's with someone who I'm trying to get on the podcast here very soon. So I'll share with you his name and hopefully get him to tell that story when I get him on the show. But I'll give you the summary. I had lunch with him early in my Fidelity career. I'd moved up to Boston. We had lunch together. We were talking, and he shared with me how he did position sizing. He's like, you have to do position sizing based on volatility. So a name that's twice as volatile, you make half the position because you want to normalize your positions based on volatility, and because that's the amount that you're really putting at risk. And I left that lunch, and I remember thinking, like, that is an important topic that I'm going to want to remember for a long time. And I've never forgotten that. I've ended up, having many great discussions with him over the years, and many, many others, because I think that's a great way to think of it. So volatility is not a bad thing. Volatility is actually a good thing because it causes charts to move and it creates opportunities for us. But do we want to overbet and have too large position sizing because of that? Absolutely not. One of my other contacts, Price Headley, said, if you're having trouble sleeping at night, your position size is too big. So let's make sure we sleep well at night with some mindful practices like reasonable position sizing. For now, I will say thank you so much for joining me on the show today. Thanks for those awesome questions. We didn't get to all of them. We will put them into the mailbag for tomorrow's all mailbag episode. But for now, I say have a joyful night. And remember, it's always a good time to own good charts. Take care, folks.